Before we begin, a quick and important disclaimer. This presentation is for educational and entertainment purposes only and does not constitute professional legal, financial, or insurance advice. The concepts discussed regarding divorce insurance and marital risk management are theoretical frameworks and historical case studies analyzed within an academic context. Insurance laws and financial regulations vary significantly by jurisdiction and are subject to frequent change. Viewers should conduct their own due diligence and consult with qualified legal and financial professionals before making any decisions related to insurance products, prenuptial agreements, or marital financial planning. The creator of this content assumes no liability for actions taken based on the information provided herein. Every single year, approximately 2 million Americans walk down the aisle, look into the eyes of their partner, and utter two words that signify the start of the most significant legal and financial contract of their lives. I do. But within the hushed corridors of American academia, from the lecture halls of the University of Chicago to the seminar rooms at Harvard Law, a controversial and unsettling question is being debated by the nation's leading economists and sociologists. If we insure our homes against fire, our cars against collisions, and our lives against the inevitable, why is it considered a social taboo to insure the one contract that has a statistical historical trend of failing nearly 50% of the time? We are entering the era of the divorce premium. For decades, the concept of divorce insurance was relegated to the fringes of financial theory, often dismissed as a cynical bet against love. However, as the cost of marital dissolution in the United States continues to skyrocket, with contested cases often reaching six figures in legal fees alone, the ivory tower has begun to reconsider. This isn't just about money. It is a deep-seated ethical discourse on the very nature of human commitment in a capitalist society. Today, we are initiating a deep-dive masterclass into the ethics, mechanics, and societal implications of divorce insurance. We will solve the mystery of why this product remains one of the most polarizing financial instruments in American history, and we will equip you with the academic framework to understand how the intersection of risk management and romance is fundamentally reshaping the American middle class. To understand the current academic fascination with divorce insurance, we must first analyze the historical trends of the American matrimonial landscape. Prior to the 1970s, the legal barrier to exiting a marriage was exceptionally high. The requirement to prove fault, such as adultery or cruelty, acted as a natural, albeit rigid, form of social insurance. When California passed the first no-fault divorce law in 1969, it triggered a domestic domino effect that fundamentally altered the risk profile of marriage. Suddenly, the option value of leaving a marriage increased, but the financial safety net for the lower-earning spouse began to erode. In academia, this is often referred to as the feminization of poverty. Following marital breakdown, researchers began to observe that while the legal freedom to leave was a triumph for individual autonomy, the economic fallout was catastrophic for many. This created a vacuum that traditional financial products failed to fill. Enter the concept of the marriage indemnity, or wedlock insurance. In the early 21st century, a few bold startups attempted to bring this to the mass market. The mechanics were deceptively simple. A policyholder would pay a monthly premium, and in return they would accrue units of coverage. If the marriage lasted, the money remained with the insurer. If the marriage ended after a specific vesting period, usually 48 months to prevent immediate fraud, the policyholder would receive a lump sum payout to cover legal fees, relocation costs, and the sudden drop in household income. The academic discourse surrounding these products centers on three primary ethical pillars: moral hazard, adverse selection, and the commodification of intimacy. Let's break these down with the rigor of a graduate-level seminar. First, we must address the moral hazard. In the world of insurance, a moral hazard occurs when the presence of insurance changes the behavior of the insured party in a way that increases the likelihood of a claim. In the context of American academia, sociologists ask, if a spouse knows they have a $100,000 payout waiting for them upon divorce, are they less likely to invest the emotional labor required to save a struggling marriage? Critics argue that divorce insurance creates a financial incentive for abandonment. However, proponents within the economic sphere counter this by pointing to historical trends in fire insurance. Does having fire insurance make you more likely to burn down your house? Generally, no, because the emotional and logistical trauma of the event far outweighs the financial indemnity. Academics are currently debating whether the trauma of divorce is a sufficient deterrent to prevent the moral hazard of a payout. They argue that for many, divorce insurance isn't a get-out-of-jail-free card, but rather a parachute for a plane that is already crashing. The second pillar is adverse selection. This is a fundamental problem in insurance where the people most likely to buy the product are the ones who know they are at the highest risk. If only couples on the brink of collapse buy divorce insurance, the system becomes unsustainable. This is why academia looks closely at the waiting periods and premium structures of these theoretical policies. For divorce insurance to work ethically and financially in the U.S. market, it would require a broad pool of healthy, stable marriages to participate, effectively subsidizing the few that fail. But this leads back to the social taboo. How do you convince a happy couple on their honeymoon to start paying a premium for their eventual breakup? This leads us to the third and perhaps most complex pillar, the commodification of intimacy. Philosophers and ethicists in American universities are concerned that by putting a price tag on the end of a marriage, we are reducing a sacred social bond to a mere transactional commodity. They argue that it changes the language of love into the language of hedging. Instead of saying, "I trust you," the act of buying a policy says, "I trust the statistics more than I trust our bond." Yet, the counter-argument presented in many family law journals is that marriage is already a financial transaction. From tax filings to property rights to Social Security benefits, the state already treats marriage as an economic unit. Is it truly unethical to provide a tool that protects the most vulnerable members of that unit? Let's look at a case study often cited in these discourses. Imagine a stay-at-home parent who has sacrificed 15 years of career growth to support their spouse's climb to the executive suite. In the current American legal system, alimony or spousal support is becoming increasingly rare and shorter in duration. If the marriage ends, that parent faces an immediate and devastating loss of human capital value. From an academic standpoint, divorce insurance for this individual isn't a bet against the marriage. It is career continuity insurance. It provides the capital necessary to go back to school, seek retraining, and bridge the gap to financial independence. When viewed through this lens, the ethics shift from cynicism to empowerment. Furthermore, we must examine the wealth gap in marital protection. Currently, the wealthy in America use prenuptial agreements as a form of private insurance. They spend tens of thousands of dollars on lawyers to ring-fence assets before the wedding. But for the average middle-class American, a prenuptial agreement is often viewed as offensive or unnecessary because they have fewer assets to protect. However, they are the ones who can least afford the $300 an hour legal fees of a divorce. Academia is exploring whether divorce insurance could serve as the great equalizer, providing the middle class with the same financial protection that prenuptial agreements provide for the top 1%. As we continue this discourse, we must look at the potential outcomes of a society where divorce insurance is normalized. Historical trends in other sectors suggest that when you mitigate risk, you actually increase participation. Could it be that by making divorce less financially ruinous, more people would be willing to take the risk of getting married in the first place? Some researchers suggest that the declining marriage rate in the U.S. is tied directly to the fear of financial ruin. If you remove the ruin, do you save the institution? This is the beginning of our deep dive. We have established the framework of the academic debate. We have identified the three ethical hurdles of moral hazard, adverse selection, and commodification. And we have challenged the notion that protecting oneself is an act of betrayal. In the subsequent parts of this masterclass, we will dissect the specific financial models used to calculate these premiums, the legal battles that have prevented these products from becoming mainstream, and the psychological impact of risk hedging on the American psyche. We are just scratching the surface of how American academia is attempting to solve the math of the broken heart. To solve the math of the broken heart, we must first confront the actuarial wall. In the world of high finance and academic risk assessment, marriage is not viewed through the lens of poetry or candlelight, but as a long-term contingent liability. To understand how one might price the end of a union, we have to look at the historical trends of survival analysis. In the current year 2026, data scientists at leading American research institutions have refined what they call the marital hazard function. This is a mathematical model that tracks the probability of a marriage ending at any given month, based on variables like age at the time of the wedding, education level, and geographic location. Imagine a couple in 2026. Let us call them Marcus and Elena. Marcus is a mid-level marketing manager in Chicago, and Elena is a physical therapist. They are 32 years old, and they are about to sign a contract for what academia calls a divorce casualty policy. For the actuaries behind this product, Marcus and Elena represent a specific risk profile. Historical trends suggest that couples who marry in their early 30s with dual incomes have a lower immediate hazard rate than those who marry in their early 20s, but their potential financial loss in a divorce is significantly higher due to accumulated assets and higher legal fees in metropolitan areas. The step-by-step mechanics of their policy are cold and calculated. Marcus and Elena agree to a monthly premium of $75. In exchange, they are not buying a promise of happiness, they are purchasing units of coverage. In the academic models used to structure these policies, one unit might equal $1,000 of indemnity. However, the policy includes a mandatory waiting period, often referred to as the nesting or vesting phase. In most theoretical and pilot programs discussed in American academia, this period is set at 48 months. If Marcus and Elena file for divorce within the first 4 years, they receive nothing. This is the primary defense against the adverse selection problem we discussed earlier. It prevents a couple who is already fighting on the way to the insurance office from gaming the system. But what happens after that 48-month mark? This is where the deep dive into the economics of the settlement begins. In the year 2026, the average cost of a contested divorce in a major U.S. city has surged to over $40,000 when you account for discovery, forensic accounting, and child custody evaluations. For Marcus and Elena, their insurance policy begins to accrue value the longer they stay married. It is a reverse incentive structure. For every year they remain together past the vesting period, the potential payout increases by a set percentage. In academic circles, this is known as the longevity bonus. It is designed to mitigate the moral hazard by ensuring that the financial benefit of staying married, and thus growing the potential payout for a later, more expensive life stage, outweighs the immediate impulse to settle for a small payout now. Consider the case study of a similar product launched briefly in the early 2010s known as wedlock. The failure of that product provides a masterclass in the intersection of legal barriers and social stigma. The creators of wedlock treated divorce as a casualty, much like a fire or a flood. But American state regulators struggled with the fundamental question: is divorce a fortuitous event? In insurance law, you cannot insure against something you can intentionally cause. If I burn down my own house, it is arson, and the claim is denied. If I choose to file for divorce, have I intentionally caused the loss? Academic legal scholars at Yale and Stanford have spent the last few years debating this exact point. The emerging consensus in these high-level seminars is that divorce is rarely the result of a single, intentional act by one party. Instead, it is the result of a systemic failure of the marital unit, often involving external economic pressures, health crises, or psychological shifts that are outside the total control of the individuals. Therefore, they argue it can be classified as a casualty. They point to historical trends where the loss of a job or a medical emergency acts as the primary catalyst for marital breakdown. In these instances, the divorce is a secondary financial trauma resulting from a primary, insured-style event. Now let us look at the potential outcomes for Marcus and Elena if they hit year 10 and decide to part ways. By this point, they have paid $9,000 in premiums. Under a standard academic model, their policy might provide them with a $60,000 lump sum. This money is specifically earmarked for what is known as transition capital. In a traditional American divorce, the lower-earning spouse often faces a liquidity crisis. They may have equity in a home, but they cannot spend a kitchen cabinet to pay for a retainer for a lawyer. The divorce insurance provides immediate liquidity. Step 1. The policyholder submits a certified copy of the divorce filing. Step 2. The insurance company verifies that the waiting period has been met and that no fraud has been committed, such as a collusive filing just to collect the cash. Step 3. The funds are disbursed, often within 30 days. In this scenario, the presence of the insurance fundamentally changes the power dynamics of the legal proceedings. When both parties have access to high-quality legal representation and the ability to maintain separate households immediately, the duration of the legal conflict often decreases. Data suggests that much of the vitriol in American divorce courts stems from the fear of impending poverty. By removing that fear, academia suggests we might actually see a decrease in the trauma experienced by children of the marriage, as the parents are not fighting a zero-sum war for survival. However, we must also look at the data regarding the potential for inflation of legal costs. Critics in the academic community argue that if every American had a $50,000 divorce insurance payout, divorce attorneys would simply raise their retainers to $50,000. This is a phenomenon known as the subsidy effect, similar to what we see in the American higher education system with student loans. If the supply of capital increases, the cost of the service often follows. This leads to the proposal of a managed care model for divorce. Instead of a cash payout, the insurance might provide access to a network of pre-voted mediators and lawyers who work at set rates, much like a health insurance PPO. This brings us to a critical junction in our discourse. If we move toward a managed care model for the end of a marriage, are we giving insurance corporations the power to decide how our families are restructured? In the seminars of 2026, this is where the ethics get truly thorny. Imagine if your insurance company denied your claim because they felt you didn't try hard enough in marriage counseling. Imagine a world where an insurance adjuster reviews your text messages to see if you were the one who moved out first. The depth of this issue goes beyond just the bank account. It touches on the very definition of personal liberty in the United States. Are we prepared for a world where the most private details of our domestic failures are scrutinized by a claims adjuster in order to unlock the funds needed to start over? As we move into the next phase of this masterclass, we will examine the dark side of this data collection. We will look at how the rise of big data and social media monitoring is giving potential insurers a window into your marriage that you never intended for them to see. If your smart fridge knows you are eating dinner alone every night, will your premiums go up next month? The math of the broken heart is getting more invasive by the second, and the legal hurdles are only the beginning. The real question is, who owns the data of your misery, and can they use it to bet against your future? We have explored the actuarial models and the case studies of Marcus and Elena, but there is a hidden layer to this industry that involves the American court system itself. There are certain states in the US where this type of insurance is currently considered an illegal form of gambling. Why does the law view a fire insurance policy as a prudent investment, but a divorce policy as a game of blackjack? And more importantly, how are lobbyists in Washington, D.C. currently working to change that definition? The answer lies in a century-old legal doctrine that is about to be challenged in a way that could change the American family forever. The doctrine in question is known as insurable interest. In the history of the United States legal system, this concept was established as a foundational barrier to prevent the insurance industry from devolving into a high-stakes casino. To understand why this matters in the year 2026, we have to look at the historical trends of the 18th century. Before the Life Assurance Act of 1774, it was a common, albeit morbid, practice for individuals to buy insurance policies on the lives of public figures or even total strangers, essentially placing a bet on when they would die. This created a perverse incentive for murder. To solve this, the law mandated that any insurance policy must be backed by a genuine financial interest in the preservation of the thing or person being insured. You cannot insure your neighbor's house against fire, because you would then have a financial incentive to see it burn. In the academic lecture halls of 2026, the debate centers on a radical question. Does a spouse have an insurable interest in their own marriage? At first glance, the answer seems obvious. Of course they do. But from a legal standpoint, the argument is more complex. Traditionally, the law viewed the end of a marriage as a choice, not an accident. If an event is within your control, it is generally considered uninsurable, because it violates the principle of fortuity. If Marcus and Elena, our couple from Chicago, take out a policy, a skeptical judge in a state like New York or Illinois might look at that contract and declare it a wagering contract rather than an insurance policy. In their eyes, Marcus and Elena aren't protecting an asset. They are betting on the failure of their union. This is where the 2026 lobbying push in Washington, D.C. becomes a critical case study in how ethics are rewritten by economic necessity. Consider the work of Chloe, a policy analyst and legal strategist working for a coalition of fintech firms and insurance giants. Chloe is currently presenting a series of white papers to the National Association of Insurance Commissioners. Her argument is based on the indemnity principle. She posits that divorce in the modern United States is no longer a simple choice made in a vacuum, but a catastrophic financial event that mirrors the loss of a home or the death of a breadwinner. Chloe's data reveals a staggering historical trend. The average American household experiences a 40% drop in income immediately following a divorce. For the lower-earning spouse, typically the woman, this often leads to a reliance on state-funded social safety nets. Chloe is making a step-by-step case that by allowing divorce insurance to be classified as a legitimate indemnity product, the government could offload the massive social cost of marital breakdown onto the private sector. If Marcus and Elena have a private policy that covers Elena's relocation and retraining costs, she doesn't end up needing state-sponsored housing assistance or SNAP benefits. From Chloe's perspective, the insurable interest isn't just personal. It is a matter of public fiscal health. However, Chloe faces a formidable opponent in the form of the doctrine of champerty and maintenance. This is a medieval legal concept that remains surprisingly relevant in 2026. Champerty occurs when a third party, in this case an insurance company, provides the financial means for someone to pursue a legal dispute in exchange for a share of the proceeds, or as part of a commercial arrangement. For centuries, the U.S. legal system has been wary of any contract that encourages litigation. If an insurance company is providing Marcus with a $60,000 payout specifically to pay for a high-powered divorce attorney, are they maintaining a conflict? Critics in academia argue that this creates an arms race in the courtroom. If both sides have insurance-funded legal budgets, a divorce that could have been settled through mediation for $5,000 might instead balloon into a 2-year scorched earth battle, simply because the money is there to be spent. This leads us to a deeper academic exploration of the valuation problem. How do you value a marriage in dollars? In fire insurance, you have an appraisal of the house. In car insurance, you have the Blue Book value. But in divorce insurance, what is the underlying asset? Some 2026 models proposed by economists at the University of Chicago suggest a human capital approach. They look at the present value of the future earnings of both spouses and the degree of domestic specialization. Imagine if Elena gave up a lucrative career in physical therapy to manage the household and Marcus's professional travel schedule. Her human capital has been diverted into the marriage. The insurance policy, therefore, isn't insuring the love. It is insuring the diverted human capital. Step by step, the industry is trying to create a standardized marital appraisal. Step 1. A baseline assessment of both parties' earning potential at the date of marriage. Step 2. A yearly audit of the household's shared assets and non-monetary contributions. Step 3. The adjustment of the premium based on the volatility of the couple's specific economic sector. Imagine if Marcus's marketing firm is in a volatile industry with a high historical trend of layoffs. Because financial stress is the leading cause of divorce in the U.S., Marcus's premium might actually increase because his marriage is statistically more at risk during an economic downturn. Here, the ethics become murky. Is it right for an insurance company to charge a couple more for their divorce policy because one of them lost their job? This is the dark irony of the system. The people who need the protection most, those in precarious financial positions, might find themselves priced out of the market. This brings us to the potential outcomes for the American family structure. Academics are divided on whether this would lead to more or less stability. On one hand, you have the safety net theory. This theory suggests that by removing the existential dread of poverty, couples can actually focus on the emotional aspects of their relationship. If you know you won't be homeless if the marriage fails, you might stay out of genuine desire rather than financial coercion. On the other hand, you have the transactional theory, which warns that once you start valuing your spouse as a fluctuating asset on an insurance ledger, the magic of the bond is replaced by the cold logic of the balance sheet. In the year 2026, we are seeing the first major test cases of these policies in states that have recently deregulated their insurance markets. We are observing couples like Marcus and Elena navigate a world where their monthly budget includes a line item for their eventual parting. But there is an even more controversial element emerging in the academic discourse: the use of artificial intelligence and predictive biometrics to determine these premiums. What if your insurance company required you to wear a device that tracked your heart rate and cortisol levels during arguments? What if they could predict a divorce 3 years before you even thought about it, simply by analyzing your speech patterns and the frequency of your interactions on social media? We are moving from the era of legal doctrines into the era of the algorithmic divorce. The ethics of who gets to hold that data, and how it can be used to deny you coverage or hike your rates, is the next frontier. As we prepare to move into Part 4, we have to ask, if the data says your marriage is going to fail, do you have a moral obligation to tell your spouse? Or do you just call your insurance agent first? The open loop of the algorithmic gaze is about to change everything we thought we knew about privacy in the American home. The algorithmic gaze is no longer a science fiction trope. In the year 2026, it is the cornerstone of risk assessment in the American insurance market. As we move deeper into this educational discourse, we must analyze the shift from static data, like age and income, to dynamic, real-time behavioral surveillance. In American academia, this is being studied as the quantified marriage. Imagine a world where your marital stability is not a feeling, but a score that fluctuates daily based on 1,000 different digital touchpoints. This is the reality facing couples who opt into the newest generation of divorce insurance policies, where premiums are tied to what is known as a marital stability score. Let us look at a case study involving a couple named Sarah and David, living in suburban Virginia in 2026. Sarah is a software engineer and David is a high school principal. Like many middle-class Americans, they were concerned about the historical trends of financial instability following a breakup. To mitigate this risk, they signed up for a cutting-edge divorce casualty policy that offers a significant discount if they agree to a process called continuous underwriting. Step by step, this is how the algorithm begins to inhabit their domestic life. Step 1 is the integration of the Internet of Things or IoT. Sarah and David's smart home system, which manages their lighting, security, and thermostat, is linked to their insurer's database. To an academic researcher at MIT studying interpersonal data governance, this provides a treasure trove of predictive indicators. The algorithm isn't looking for a single argument. It is looking for deviations from a baseline. If Sarah and David typically spend their evenings in the same room, indicated by smart lighting and motion sensors, but suddenly begin spending 6 hours a night in separate wings of the house for 3 weeks straight, the system flags this as domestic decoupling. Step 2 involves the analysis of financial synchronicity. In the year 2026, most American transactions are digital and instantaneous. The insurance algorithm monitors Sarah and David's shared accounts versus their individual ones. Historical trends suggest that when one spouse begins to divert a higher percentage of their paycheck into a private account, or when there is a sudden spike in individual spending at restaurants or hotels not shared by the couple, the probability of a marital rift increases by 24%. For Sarah and David, a weekend where Sarah spends $300 at a boutique hotel 40 miles away, without a corresponding charge from David's account, triggers an immediate risk recalibration. The most controversial step, Step 3, is the use of predictive biometrics. As part of their policy, Sarah and David wear high-end fitness trackers that monitor heart rate variability and cortisol levels. In academic circles, this is known as monitoring the allostatic load of a relationship. Allostatic load refers to the wear and tear on the body that accumulates as an individual is exposed to repeated or chronic stress. If the trackers detect that Sarah's cortisol levels spike every day at 6 p.m., exactly when David returns from work, and remain elevated until she goes to sleep, the algorithm interprets this as chronic interpersonal stress. From an educational standpoint, we must ask, what are the potential outcomes of this level of surveillance? In a 2025 study published in the Journal of Marital Economics, researchers found that couples under continuous biometric monitoring reported a secondary form of stress called performance anxiety. They were no longer just living their lives, they were performing a stable marriage for the benefit of an algorithm. Sarah and David find themselves hesitating to have a difficult conversation or a necessary argument because they fear a spike in their biometrics will lead to a higher insurance premium the following month. This is the ultimate irony. The very tool meant to provide security is creating a new layer of psychological fragility. Furthermore, academia is sounding the alarm on a phenomenon known as information asymmetry. In our case study, what happens if the insurance company identifies a high probability of divorce before David or Sarah even realizes they are unhappy? Imagine if Sarah receives a notification on her phone suggesting she visit a marriage counselor, or worse, an advertisement for a local moving company, because the algorithm has detected a shift in her behavior that she hasn't consciously acknowledged. This creates a moral vacuum. Does the insurer have a duty to inform the policyholder of their own impending domestic crisis? Or do they simply use that data to hedge their own financial bets? The economic spillover of this data is equally significant. In 2026, your marital stability score is not isolated to your divorce insurance policy. Because historical trends show that divorce is one of the leading causes of mortgage default and bankruptcy, other financial institutions are beginning to buy this data. If Sarah and David apply for a car loan, the lender may check their divorce risk profile. If the algorithm says they have a 60% chance of splitting within the next 2 years, they might be hit with a higher interest rate or denied the loan entirely. This is the birth of the marital credit score, a metric that could determine a family's access to the American dream based on the perceived health of their private intimacy. Academic critics of surveillance capitalism, such as those at Harvard's Berkman Klein Center, argue that this creates a new form of social stratification. The wealthy can afford to pay higher premiums for a private policy that doesn't track their every move. Meanwhile, the middle and lower classes like Sarah and David are forced to trade their privacy for financial protection. It creates a world where the poor are monitored for their failures, while the rich are allowed the dignity of a private decline. The depth of this ethical quagmire extends to the children of the marriage. If the smart home detects a high-conflict environment through acoustic sensors, essentially listening for the frequency and volume of raised voices, does the insurance company have a reporting requirement? In some theoretical academic models, if the risk of a messy, high-conflict divorce exceeds a certain threshold, the insurer might be required by state law to share that data with Child Protective Services. We are looking at a future where your insurance agent is effectively a digital social worker with a profit motive. As we conclude this segment of our deep dive masterclass, we have to confront the most unsettling potential outcome of all: the pre-crime of divorce. If an insurer can predict with 99% accuracy that a marriage will end in the next 6 months, can they cancel the policy to avoid a payout? This is the legal battle currently brewing in the United States courts. If the loss is inevitable based on the data, is it still a fortuitous event? Or is the contract now void? We have explored the hardware and the software of the algorithmic marriage. We have seen how Sarah and David's lives are being distilled into a series of risk-weighted data points. But there is a final, even more radical shift occurring in American academia regarding the very nature of the divorce insurance payout itself. It isn't just about cash anymore. In Part 5, we will investigate the rise of the service-based indemnity. What if your insurance doesn't pay you in dollars, but in automated life restructuring services? From AI-generated legal filings to algorithmic asset division, the machine isn't just watching the end of the marriage, it's preparing to manage the aftermath. But who is the machine really working for, you, or the bottom line of the corporation that predicted your downfall? The transition from cash-heavy payouts to service-based indemnity represents the most significant pivot in the history of American risk management. In academic circles, this is often discussed as the shift from the compensatory model to the restorative model. In a traditional insurance scenario, if your car is totaled, the company cuts you a check for the market value, and you are left to navigate the complexities of finding a new vehicle on your own. However, in the year 2026, the divorce insurance industry is increasingly adopting a managed care approach that mirrors the Health Maintenance Organization or HMO structure. This is known as service-based indemnity or SBI. To understand the mechanics of SBI, let us look at a case study involving a couple named James and Linda, residing in Columbus, Ohio. James is a commercial architect and Linda is a specialized research librarian. In 2026, they are 3 years into a high-tier marital casualty policy. Unlike the policies of the early 2020s, theirs does not promise a flat $100,000 payout. Instead, their policy functions as a comprehensive life restructuring platform. The process begins with the triggering event. In the world of SBI, the trigger is rarely a surprise. As we discussed in the previous segment, the algorithmic gaze has already flagged the high probability of dissolution. When James and Linda finally reach the decision to separate, they do not start by calling separate, combative attorneys. Instead, they log into a unified marital dissolution portal provided by their insurer. Step 1 is what academics call algorithmic asset neutralization. In a standard American divorce, the discovery phase, where both parties reveal their financial holdings, is a months-long, expensive process prone to hiding assets and deep-seated resentment. James and Linda's policy bypasses this through a technique called API-driven financial transparency. The insurer's software has had read-only access to their accounts for years. Within seconds, the algorithm generates a comprehensive map of their shared and separate property. But it goes a step further into a controversial area of academic study: emotional utility asset allocation. Imagine if James and Linda are fighting over a specific piece of mid-century modern furniture or a shared art collection. Instead of a judge spending 3 hours listening to their emotional history with a coffee table, the algorithm analyzes their historical interactions with that asset. It looks at who purchased it, who cleaned it, who photographed it for social media, and even who spent more time in the room where it was located based on smart home data. The algorithm then assigns a utility score to the item for each person. Step by step, the machine builds a division of property that maximizes the total psychological utility for both parties, aiming to reduce post-divorce regret. Academic researchers at the University of Pennsylvania have termed this the black box of asset division. The ethical concern here is profound. If the algorithm decides James gets the house because he is closer to his office, but Linda gets the bulk of the liquid assets because her risk profile suggests she needs more mobility, have they lost their agency? In 2026, The potential outcomes of this automation are being studied through the lens of procedural justice. Studies suggest that when humans feel they have no say in the process, even a fair outcome can feel like an injustice. Yet, the data also shows that these algorithmic divisions are completed in 72 hours, compared to the 14-month average of a traditional Ohio court case. The next step in James and Linda's SBI policy is the Custody Optimization Protocol. This is perhaps the most sensitive area of American academia's involvement in family law. Rather than a bitter battle over weekends and holidays, the insurer's AI analyzes the children's school schedules, extracurricular activities, and biometric sleep patterns. It then cross-references this with James and Linda's work calendars and proximity to the school. The resulting parenting plan is not a static document, but a dynamic, data-driven calendar that adjusts in real time. If James has a late-night deadline, the system automatically shifts the childcare responsibility to Linda and logs a credit to James's time bank for the following week. From an educational standpoint, this is referred to as the algorithmic co-parenting model. Proponents argue it removes the opportunity for parents to use the children as pawns in a financial game. However, critics in the academic legal community warn about the vertical integration of the divorce industrial complex. In 2026, the insurance company that manages James and Linda's policy often owns the legal firm that files the paperwork, the mediation service that settles the disputes, and even the moving company that transports their belongings to separate apartments. This vertical integration allows for a phenomenon known as the loss mitigation loop. Because the insurer is paying for the services, it has a massive financial incentive to keep those services as cheap and efficient as possible. This leads to the use of tech law hybrids, AI-driven legal services that can file a no-fault divorce in all 50 states without a human lawyer ever touching the file. For James and Linda, this means their transition cost is nearly zero out of pocket, but it also means they are navigating the most traumatic event of their lives within a corporate ecosystem designed for efficiency, not necessarily empathy. Historical trends in the United States show that as services become more automated, they also become more standardized. Academics are concerned that we are moving toward a cookie-cutter divorce where individual nuances, such as cultural traditions, religious requirements, or unique family dynamics, are smoothed over by the algorithm in favor of the most statistically probable successful outcome. If James and Linda had a specific religious requirement for their children's upbringing, would a profit-motivated insurance algorithm prioritize that? Or would it prioritize the schedule that is most efficient for the parent's earning potential? Furthermore, we must consider the post-divorce concierge services that are now standard in 2026 policies. These services provide lifestyle restructuring, which includes everything from resume optimization for the lower-earning spouse to automated apartment hunting within the same school district. On the surface, this is an incredible value add. It solves the immediate logistical nightmare of a breakup. But deep dive analysis by sociologists suggests this creates a subscription to singlehood. If your insurance company is the one finding your new apartment and setting up your utilities, you are no longer just a policyholder. You are a captive consumer of their entire ecosystem. The depth of this corporate involvement leads us to a startling data point. In 2026, approximately 30% of new marriages in tech-heavy metropolitan areas like Austin, Seattle, and San Francisco are opting for these service-based policies. The potential outcomes are a more stable middle class that can survive the shock of divorce without falling into poverty. But the trade-off is the total surrendering of family privacy to a corporate entity. As we conclude Part 5, we have moved from the why of divorce insurance into the how of its automated execution. We have seen how James and Linda's lives were uncoupled not by a judge, but by an optimized script. But there is an even more radical development on the horizon that is currently being debated in the most elite academic circles. It involves a technology that could make the very concept of a divorce filing obsolete. We are talking about the move toward smart contracts for marriage, self-executing agreements where the marriage literally expires or renews based on preset conditions. What happens to the American family when the I do comes with an expiration date written in code? The ethics of the temporary marriage are the next stop in our masterclass, and the data suggests we are closer to this reality than anyone wants to admit. The transition from marital casualty policies to the world of self-executing smart contracts represents a seismic shift in how American academia conceptualizes the duration of human commitment. In the year 2026, the concept of a marriage contract is undergoing a digital metamorphosis, moving away from a dusty piece of paper stored in a county clerk's office and toward a dynamic, code-based agreement hosted on a decentralized ledger. This is the era of the renewable marriage, a term coined by sociologists at the University of Southern California to describe a union that does not end in a traditional divorce, but simply reaches its programmed expiration date. To understand how this interacts with divorce insurance, we must first analyze the mechanics of the smart contract itself. Imagine a young professional couple in 2026. Let us call them Sophia and Liam. Sophia is a biostatistician and Liam is a consultant for sustainable energy grids in Seattle. When they decided to marry, they opted for a marriage as a service or MaaS model. Their marriage contract is essentially a sophisticated piece of software, often referred to in legal tech circles as a marital smart contract. Unlike a traditional marriage which is open-ended, Sophia and Liam's contract has a defined term of 5 years. The step-by-step logic of their agreement is governed by what is known as a sunset clause. Step 1 involves the minting of their marital digital identity. This identity is linked to their shared financial accounts, their property titles, and their individual insurance profiles. Step 2 is the integration of a marital oracle. In the world of blockchain, an oracle is a third-party data feed that provides real-world information to a smart contract. Sophia and Liam's oracle pulls data from their biometric trackers, their shared calendar, and their GPS-verified residency patterns. Step 3 is the critical phase, the renewal window. As they approach the end of their 5-year term, the smart contract enters a 90-day evaluation period. If both Sophia and Liam do not digitally sign the renewal clause by the end of year 5, the contract does not go into a breach, it simply expires. Because the contract has expired, the insurance policy they have been paying into for 5 years recognizes this as an insured event. From an academic perspective, this is a revolutionary approach to risk management. Historical trends in the U.S. show that the most expensive and psychologically damaging part of a divorce is the uncertainty of the outcome and the battle over who is at fault. In the MaaS model, there is no fault. There is only the end of the term. The insurance company, which has been acting as a silent stakeholder in the marriage, immediately triggers a pre-negotiated payout. Because the asset division was coded into the contract on day 1, there is no discovery phase, no mediation, and no litigation. Sophia receives her transition capital, Liam receives his, and they move into their separate lives with the surgical precision of a corporate spin-off. In the lecture halls of Harvard and Stanford, this is being debated as the end of the divorce. If a marriage can expire gracefully, does the trauma of divorce still exist? Professors of psychology argue that by removing the social stigma of failure and replacing it with the logic of a contract renewal, we may be creating a more honest society. They point to case studies from the early 2020s where couples stayed in high-conflict environments for decades simply because the financial and legal barriers to exit were too high. The smart contract, backed by divorce insurance, provides a dignified exit ramp. However, the potential outcomes of this model are not entirely positive. Ethicists are concerned about the commodification of time. If you know your marriage is up for renewal in 12 months, does that change how you treat your spouse? Does it create a honeymoon phase every 5 years? Or does it lead to a cynical performance of stability, just to ensure the insurance payout is not jeopardized? There is also the problem of the oracle breach. Imagine if Liam, wanting to ensure the contract expires so he can collect the payout and leave, begins to manipulate the data. He might intentionally create a digital trail of domestic decoupling, spending nights away diverting funds, to trigger the insurance company's risk algorithms. This leads to a fascinating area of 2026 research, forensic smart contract auditing. Just as we have forensic accountants today, the future involves specialists who audit the code and the data feeds of a marriage to ensure that one party didn't sabotage the relationship for financial gain. The insurance companies are the ones driving this research. They want to ensure that they are only paying out for genuine marital expirations, not orchestrated ones. Furthermore, we must look at the impact on the American middle class. Data from 2026 suggests that the adoption of renewable marriage contracts is highest among the 25 to 35 age demographic. This group, having witnessed the devastating historical trends of their parents' divorces, views the open-ended marriage as an unacceptable financial risk. They see the 5-year renewable term as a way to protect their human capital. If Sophia spends 5 years supporting Liam's career, and they don't renew, the insurance payout acts as her deferred compensation. But what about the children? This is where the academic discourse becomes truly heated. Traditional family advocates argue that children need the permanent, till death do us part stability of a traditional marriage. But contemporary sociologists counter with data showing that children are more damaged by long-term exposure to parental conflict than by a clean, planned transition. They argue that a renewable marriage contract allows for a planned co-parenting transition that is funded by the insurance company, ensuring the children's lifestyle remains consistent across two households. The depth of this shift cannot be overstated. We are moving toward a world where the American family is structured like a series of venture capital rounds. You have the seed stage, the first 5 years, the Series A, the first child and the first renewal, and so on. At each stage, the insurance premium is recalibrated based on the success of the previous term. If a couple successfully navigates 2 5-year terms, their premium for the third term might drop significantly because they have proven their ability to cooperate and renew. As we peel back the layers of this digital domesticity, we find that the very definition of a successful marriage is being rewritten. Success is no longer measured by longevity, but by the quality of the contract and the lack of friction during the expiration. The insurance industry is no longer just a safety net. It is the architect of these new social structures. But there is a dark side to this efficiency. If every marriage is a contract with an expiration date, what happens to the concept of unconditional love? Is there a place for the irrational, the messy, and the enduring in a world governed by smart contracts and actuarial tables? And more importantly, as these American academic theories begin to export globally, how are they colliding with cultures that view marriage as an unbreakable spiritual bond? We have explored the code and the contracts of the future. We have seen how Sophia and Liam can part ways with a digital signature and a pre-funded bank account. But there is another side to the insurance market that we haven't touched on yet. While one side of the industry is preparing for the end of the marriage, a new, even more controversial sector is emerging: anti-divorce insurance. These are policies that do not pay you to leave, they pay you to stay. They are high-stakes financial incentives designed to keep couples together at all costs. But who is paying those premiums, and what happens when the money is the only thing holding the house together? The ethics of the golden handcuffs are the next chapter in our masterclass, and the data will shock you. The concept of the golden handcuffs in the marital context represents the inverse of everything we have discussed thus far. While casualty-style divorce insurance aims to provide a soft landing for a falling relationship, a new and highly controversial academic movement is exploring the mechanics of what is known as the marital retention bonus, or MRB. In the elite financial circles of 2026, these are not just simple agreements. They are high-stakes insurance products designed to prevent the financial and social fallout of a breakup before it even begins. In American academia, specifically within the behavioral economics departments of the Ivy League, researchers are studying the potential outcomes of using massive financial incentives to artificially extend the life of a marriage. To understand the sheer scale of this, imagine a couple in 2026 named Benjamin and Clara. Benjamin is a senior vice president at a global investment firm in Manhattan, and Clara is a high-profile civil engineer. Their marriage is not just a personal union. It is a critical component of their professional and familial brand. In Benjamin's world, a divorce is viewed as a systemic risk. It signifies a potential loss of focus, a messy liquidation of stock options, and a disruption of the firm's stability. To mitigate this, Benjamin's employer has integrated a marital stability clause into his executive compensation package, backed by a third-party retention insurer. The step-by-step mechanics of Benjamin and Clara's policy are fascinating and, to many, deeply unsettling. Step 1 involves the establishment of the marital milestone. The insurer sets specific temporal goals: 5 years, 10 years, and 15 years of continuous marriage. Step 2 is the verification process. Unlike standard insurance, which waits for a claim, this policy performs a marital performance audit every 24 months. This audit involves a review of shared tax returns, verified cohabitation through smart home data, and even mandatory attendance at high-level marital retreats. Step 3 is the payout, but with a twist. If Benjamin and Clara reach their 10-year anniversary without a legal separation or a divorce filing, the insurance company triggers a massive retention bonus, often in the form of restricted stock units or a direct contribution to a shared legacy trust. For a couple like Benjamin and Clara, this bonus can exceed $500,000. From an academic standpoint, this is a direct application of what is known as extrinsic motivation theory. The goal is to make the cost of leaving so high that the couple is forced to find a way to resolve their differences. In the lecture halls of the University of Chicago, economists are analyzing the historical trends of these retention bonuses. They call it the marital price floor. By setting a high financial reward for staying together, you effectively increase the price of an exit. However, psychologists in the same institutions point to a phenomenon called the overjustification effect. This is a psychological trend where providing an external reward for a behavior that was previously intrinsic actually diminishes the original internal motivation. In simple terms, if Benjamin and Clara are staying together for the $500,000 bonus, they may eventually lose the ability to stay together for love. The marriage becomes a job, and like any job, it can lead to burnout. Consider the broader case studies involving what academia calls the multigenerational stability bond. In 2026, wealthy American families are increasingly using these insurance products to protect family legacies. Imagine a patriarch who wants to ensure his grandchildren are raised in a stable two-parent household. He purchases a high-premium policy for his children's marriages. If the children stay married and meet specific stability metrics, the insurance company pays out a quarterly dividend to the family office. If they divorce, the policy is forfeited, and the financial penalty to the family's net worth is substantial. From an educational perspective, we must examine the ethical discourse surrounding the concept of economic coercion. Is it ethical to use a financial instrument to keep two people in a relationship that may no longer be healthy? Academics at NYU Law are currently debating whether these contracts constitute a form of modern indentured servitude. If Clara is unhappy but realizes that leaving Benjamin would cost her and her children millions of dollars in insured bonuses, is she truly a free agent? The potential outcomes of these policies include a decrease in the raw divorce rate, but an increase in what sociologists call the gray marriage, a state where the couple is legally and financially bound but emotionally and physically estranged. The data from 2026 shows a startling correlation. In zip codes where these anti-divorce insurance products are prevalent, the recorded divorce rate has dropped by 15% over the last 3 years. However, the use of antidepressants and the demand for separate living counseling have spiked by nearly 30%. This is the hidden cost of the golden handcuffs. We are creating a statistical illusion of stability that masks a growing infrastructure of domestic unhappiness. Step by step, the industry is also developing the marital health score to justify these retention bonuses. Step 1. Continuous monitoring of shared communication channels for what linguists call positive sentiment frequency. Step 2. Analyzing the frequency of shared social experiences through digital receipts and calendar integration. Step 3. Correlating this data with the couple's physical health metrics. If the data shows that Benjamin and Clara are arguing less, but their physical health is declining due to chronic stress, the insurer faces a paradox. Is the marriage successful if it is physically taxing to maintain? In the academic deep dive into this topic, we find that the definition of a successful marriage is being shifted by the insurance industry from an emotional state to a purely functional one. A marriage is successful if it doesn't break, regardless of the internal tension. Furthermore, we must consider the corporate marital policy. In the hyper-competitive American job market of 2026, some firms are beginning to view a stable marriage as a quantifiable asset, much like a degree or a specialized certification. They argue that a happily married employee is more likely to be a long-term, high-performing asset. Therefore, they are willing to subsidize the premiums for anti-divorce insurance as a form of talent retention. This leads to a world where your HR department has a vested interest in your anniversary. Imagine your boss congratulating you on your 7th anniversary not out of kindness, but because it triggers a lower insurance risk rating for the entire department. The depth of this intrusion into the private life is the central theme of 2026 academic symposiums. We are witnessing the final erasure of the line between the boardroom and the bedroom. As we look at the historical trends, we see that every time humans have tried to commodify an emotion, the emotion itself has been fundamentally altered. By turning marital longevity into a risk-weighted asset, we are changing the very nature of American commitment. As we move toward the final segments of this masterclass, we have to ask the ultimate question. What happens when the insurance industry decides that a marriage is no longer worth saving? We have talked about payouts for leaving and bonuses for staying, but there is a third category emerging in 2026 that is the most radical of all: the forced dissolution. This occurs when the data suggests that a marriage is so toxic that it is a liability to the insurer's other products, such as life or health insurance. The machine that was designed to protect the union may soon have the power to demand its end. The legal battle over who has the final say, the heart or the algorithm, is about to reach the highest courts in the land. The open loop of the algorithmic divorce is closing, and the implications for the future of the American family are nothing short of revolutionary. The revolutionary implications of the algorithmic divorce are currently manifesting in a legal battleground that academic scholars refer to as the era of compulsory liquidation. In the year 2026, we are witnessing the emergence of the involuntary termination clause. This is a radical development where the insurance provider, rather than the spouses, initiates the dissolution of a marriage. This concept is currently the subject of intense scrutiny in American law reviews, as it challenges the fundamental right to marital privacy and the freedom of association. To understand the gravity of this, we must look at a theoretical yet highly plausible case study involving a character named Robert, an aerospace engineer in Denver, Colorado. Robert and his wife Sarah have what is known in 2026 as a lifestyle multi-risk bundle. This product integrates their health insurance, life insurance, and divorce insurance into a single, data-driven ecosystem managed by a multinational conglomerate. Over the course of 18 months, the system's marital stability oracle begins to detect a pattern of what academia calls inter-product risk contamination. The smart sensors in their home record increasing frequencies of high-decibel verbal altercations. Their biometric wearables show that Robert's resting heart rate and blood pressure are consistently 20% higher during the hours he is at home compared to when he is at his office. Simultaneously, the algorithm notes that Sarah has begun seeking treatment for stress-induced insomnia and chronic migraines. From the perspective of the insurer, this marriage is no longer a neutral asset. It has become a primary pathogen. The data suggests that if Robert and Sarah stay married, the probability of Robert suffering a high-cost cardiac event within the next 3 years increases by 65%. Furthermore, the likelihood of Sarah filing a long-term disability claim for mental health reasons surges by 40%. The insurance company, acting under a newly proposed legal doctrine, known as the duty to mitigate systemic loss, issues a notice of compulsory liquidation. Step by step, the machine begins to dismantle the union to protect its financial exposure. Step 1 is the mandatory premium escalation. Robert and Sarah receive a notification that their health insurance premiums will triple unless they undergo a supervised 90-day separation. Step 2 is the withdrawal of coverage. The insurer informs them that their divorce insurance policy, which was designed to pay for a graceful exit, will be forfeited if they do not initiate legal proceedings within 6 months. The logic is cold. The insurer would rather pay a $60,000 divorce claim now than a $2 million life insurance claim later. In the academic seminars of 2026, this is being debated as the corporate usurpation of the state's role. Historically, only the state had the power to dissolve a marriage through the court system. Now, through the leverage of insurance and financial access, private corporations are effectively forcing the end of domestic partnerships. Legal scholars at the University of Colorado are currently preparing a case to reach the Supreme Court, tentatively titled Insercorp v. the state, which asks a singular, terrifying question. Does a citizen have the right to stay in a marriage that is statistically proven to be killing them, or can a corporation force a divorce to protect its bottom line? Historical trends in the United States have always moved toward greater individual autonomy, but 2026 data suggests a countertrend toward algorithmic paternalism. This is the belief that the machine knows what is better for us than we do. In Robert's case, the insurer argues that by forcing the divorce, they are actually performing a life-saving intervention. They point to case studies from the early 2020s where high-conflict marriages led to tragic outcomes that could have been avoided if the financial incentives for separation had been applied earlier. The depth of this ethical discourse extends to the concept of data-fault divorce. In the old world, we moved toward no-fault divorce to reduce conflict. But the insurance industry is effectively bringing fault back through the back door, using data. If the algorithm can prove that one spouse is the primary driver of the stress, the source of the biometric spikes in the other, the insurer may attempt to deny that spouse their share of the payout. This creates a new form of digital surveillance within the home, where spouses might try to manipulate the sensors to make the other look like the high-risk party. Imagine if Robert begins to intentionally trigger loud noises or stressful situations to make Sarah's heart rate spike, knowing that the insurance company's algorithm is watching and will eventually favor him in the forced liquidation. This is the dark potential outcome of turning the home into a laboratory of risk assessment. Academia calls this the gamification of domestic sabotage. It turns the most intimate relationship into a zero-sum game of data management. Furthermore, we must analyze the economic impact on the American legal profession. In 2026, traditional divorce attorneys are being replaced by data arbitrators. These are professionals trained in both law and data science who negotiate the terms of a forced dissolution. They don't look at testimony, they look at logs. They don't argue about feelings, they argue about the validity of the censors. The educational requirement for these roles involves a deep dive into machine learning ethics and actuarial science, moving far away from the traditional humanities-based approach to family law. The academic discourse also highlights the impact on social equity. If forced dissolutions become the norm for those with high-end insurance bundles, will we see a two-tier society? On one side, the insured elite whose marriages are managed and terminated by efficient algorithms. On the other, the uninsured who are left to suffer in toxic environments because they lack the financial safety net to leave. Some researchers suggest that the right to divorce might become a luxury, while others argue that the right to stay married will become the ultimate act of rebellion against the corporate state. As we reach the depth of this masterclass, we have moved from the initial concept of a simple insurance policy into a world where your domestic life is a managed portfolio. We have seen how Robert and Sarah's marriage was not just a romantic bond, but a series of interconnected risks that a corporation decided were too expensive to maintain. The ethics of this are being written in real time in the lecture halls of 2026. But there is a final, even more expansive layer to this discourse. While the United States is currently the primary testing ground for these products, the 2026 data shows a massive push to export these models globally. However, as these algorithmic divorce products hit the shores of cultures with vastly different views on family, honor, and the sacred, we are seeing a catastrophic cultural clash. In Part 9, we will investigate the global marital hegemony, how American academic theories of risk are being forced onto the rest of the world and the violent resistance they are meeting. The open loop is no longer just domestic, it is geopolitical, and the stakes involve the very definition of what it means to be a family on a global scale. The concept of global marital hegemony represents the moment American academic theories of marital risk management leaped across the oceans to collide with the foundational structures of international society. In the year 2026, this is no longer a localized debate within the Ivy League. It has become a flashpoint for what researchers at the London School of Economics and Georgetown University call actuarial colonialism. This is the systematic export of the American quantified marital model, a model predicated on individual autonomy and data transparency, into nations where marriage is viewed as a collective, sacred, or even sovereign bond. To understand the depth of this geopolitical friction, we must look at how the 2026 American insurance market is attempting to rewrite the social contracts of the world through a process known as cultural risk arbitrage. Imagine a global strategy officer named Michael, working for one of the primary Silicon Valley insurance conglomerates in 2026. Michael's objective is to expand the Unitas Marital Stability Suite into the Southeast Asian market, specifically focusing on Indonesia and Malaysia. In these regions, historical trends show that marriage is often governed by a complex interplay of civil law, religious tenets, and deep-seated family honor codes. Michael's step-by-step implementation plan is a masterclass in the technical challenges of globalized ethics. Step 1 is the adaptation of the marital oracle to local religious standards. In a process academia calls hybridized actuarialism, Michael's team must attempt to code Sharia or customary law into the smart contract. For example, if a local tradition requires a cooling-off period governed by an elder council, the American insurance algorithm must be programmed to recognize the council's input as a valid data feed. However, the ethical rift occurs when the algorithm's biometric data, showing a high-conflict environment, conflicts with the council's desire to keep the family together for the sake of community harmony. Who has the final authority? The elder or the Amazon Web Services server? Step 2 involves the financial atomization of the collective. In many of these cultures, wealth is not held by the individual or even the couple. It is held by the extended clan. When Michael's American-style policy triggers a payout directly to a wife following a divorce, it fundamentally disrupts the local power structure. In American academia, this is studied as the empowerment paradox. While the insurance provides individual financial freedom, it simultaneously severs the woman from her traditional support network, making her entirely dependent on the global insurance provider. Data from 2026 pilot programs suggest that in these jurisdictions, the arrival of divorce insurance is often met with the rise of shadow families, couples who are legally and financially separated, according to the American algorithm, but who remain physically together to avoid the social stigma of a public split. This leads to the third and most volatile step, the confrontation with the honor code. In many societies, The intimate details of marital discord are protected by a silence that is considered essential for social stability. The 2026 American model, however, thrives on the total transparency of the quantified self. If Michael's algorithm flags domestic strife because it detects a spike in cortisol levels or a change in household speech patterns, it effectively outs a family's private shame to a corporate entity thousands of miles away. This has triggered what sociologists call the Great Data Resistance. In several 2026 case studies, we see families in Jakarta or Kuala Lumpur intentionally spoofing their sensors, putting their fitness trackers on household pets or playing recorded sounds of laughter near acoustic sensors to protect their family's reputation from the American insurance gaze. From an educational standpoint, we must analyze the potential outcomes of this data sovereignty battle. Academic legal scholars at the University of Virginia argue that we are witnessing the erosion of judicial sovereignty. If an American insurance firm can trigger the liquidation of assets in a foreign country based on its own internal data, it is essentially bypassing that country's judicial system. In 2026, we are seeing the first major international lawsuits where sovereign nations are accusing U.S. insurance firms of social fabric tampering. The argument is that by making divorce a predictable, insured event, these companies are devaluing the cultural and religious sanctity of the union, leading to a long-term decline in national population stability. Furthermore, we must explore the emergence of macromarital hedging. In a radical 2026 academic proposal, some economists suggest that entire governments should take out insurance policies against their national divorce rates. If a country's divorce rate exceeds a certain threshold, potentially leading to a drop in the birth rate and a subsequent labor shortage, the insurance policy would pay out to the national treasury to fund pronatalist incentives or childcare subsidies. This turns the American theory of marital insurance into a tool of statecraft. But the ethics are harrowing. Would a government then use its surveillance apparatus to force couples to stay together, just to keep the national insurance premiums low? The depth of this geopolitical discourse also touches on the concept of the digital diaspora. As individuals from these cultures move to the United States, they find themselves caught between two worlds. Imagine a first-generation American couple. Let us call them Amir and Fatima. They want the financial security of an American divorce insurance policy, but they are terrified that the data will be accessible to their traditional families back home. The 2026 market has responded with privacy-shielded marital tunnels, specialized insurance products that promise to encrypt marital data so deeply that not even the policyholder's family or the state can see the triggers. But in the academic world, the question remains: if you have to hide your insurance from your culture, is the insurance itself an act of cultural betrayal? Historical trends in the United States have always favored the commodification of risk, but as we reach this point in our masterclass, we see that risk is not a universal language. What Michael views as a prudent financial product, a local cleric in a remote province views as a weapon of moral destruction. The 2026 data shows that for every successful expansion of American marital insurance, there is a corresponding rise in tradition bonding, a countermovement where couples sign high-penalty no-exit contracts that are the antithesis of the American model. These bonds use the same 2026 technology to lock people in, rather than providing an exit. We have now traveled from the ethics of the individual to the stability of the nation and finally to the clash of civilizations. We have seen how a simple monthly premium in Chicago can trigger a social revolution in Indonesia. But as we move into the final concluding part of this masterclass, we must bring the discourse back to its most essential human element. We have talked about code, data, geopolitics, and money. We have analyzed the machine that manages the heart. But we haven't yet addressed the ghost in the machine. In Part 10, the finale of this deep dive, we will examine the psychological toll of living in a world where love is a hedged bet. We will look at the first generation of insurance children, kids who have grown up knowing that their parents' union was a managed risk with a pre-funded expiration date. Does the removal of financial ruin also remove the depth of the commitment? Or are we finally reaching a point of marital enlightenment, where we can love without the fear of the fall? The final data points of the 2026 American academic experiment are about to be revealed, and they will force you to question everything you thought you knew about the price of I do. The final data points of the 2026 American academic experiment are about to be revealed, and they will force you to question everything you thought you knew about the price of I do. As we step into the final corridor of this deep dive masterclass, we must confront the most profound outcome of this decade-long shift in risk management: the psychological residue left on the first generation of Americans who grew up in the shadow of insured intimacy. In the hallowed halls of developmental psychology at the University of Pennsylvania, researchers are currently tracking a cohort known as the insurance children. These are the young adults like 21-year-old Caleb from Austin, Texas, who were born into households where the marital contract was not just a romantic bond, but a continuously monitored, high-stakes financial portfolio. For Caleb, the concept of a permanent, unconditional union is not a reality. It is an academic fossil. He grew up watching his parents participate in a marital performance audit every 24 months to maintain their low premiums. He saw his mother adjust her behavior based on the smart home sensors and witnessed his father's relief when they hit their tenure retention bonus. To Caleb and his peers, marriage is a series of strategic maneuvers designed to avoid the catastrophic liquidation of assets. From an educational perspective, this has led to a phenomenon academia calls emotional hedging. Caleb does not enter a relationship with the intent of total vulnerability. He enters with a pre-calculated exit strategy. He views love not as a leap of faith, but as a risk-weighted investment. The step-by-step psychological impact on this generation is being categorized by 3 distinct behavioral trends. Step 1 is the normalization of the transactional gaze. For youth in 2026, the first question in a serious relationship is no longer about shared values, but about shared risk profiles. They perform a digital due diligence on their partner's marital stability score before the 3rd date. Step 2 is the erosion of conflict resilience. Because the insurance policy provides an efficient, automated exit ramp, the generation raised in this environment has less incentive to develop the gritty, difficult skills of long-term reconciliation. Why fix the car when the total loss payout is so seamless? Step 3 is the rise of the subscription mindset. If your parents' marriage was a 5-year renewable contract, why should yours be any different? This leads to a societal shift where commitment is viewed as a temporary license rather than a permanent deed. However, the 2026 data from the National Marital Risk Longitudinal Study presents a counterintuitive potential outcome. While the depth of emotional vulnerability may be declining, the stability of the American middle class is, for the first time in 50 years, trending upward. By removing the financial ruin associated with divorce, the insurance industry has effectively created a floor for the American family. We are seeing a historical trend where the feminization of poverty following a breakup is being mitigated by the service-based indemnity models we discussed in earlier parts. For a woman like Maya, a 34-year-old mother in Seattle, the insurance-led dissolution of her marriage didn't mean a move into a predatory rental market or a loss of health care. It meant a subsidized transition into a corporate-managed apartment complex within her children's school district, with her retraining costs fully covered by the premium she and her husband paid for a decade. From an academic ethics standpoint, this presents the ultimate paradox of 2026. Is it better to have a society of high-emotion, high-risk marriages that often end in devastating poverty, or a society of calculated, risk-managed unions that end in efficient, sterile transitions? This is the debate currently raging in the philosophy departments of American academia. They call it the sterile stability versus the fertile chaos. The data suggests that we are choosing the former. We are opting for a world where the machine manages our heartaches to ensure our bank accounts remain intact. To deepen our understanding of this shift, we must analyze the final step-by-step protocol of what is now known as the enlightened exit. Imagine a 2026 couple, let us call them Ethan and Sophia, who have realized their marriage has reached its natural conclusion. Step 1. They activate the transition clause in their multi-risk bundle. Step 2. The insurer's AI initiates the neutral asset division, removing the need for a single hostile legal meeting. Step 3. The children are transitioned into a dual household schedule, managed by a centralized co-parenting app that coordinates logistics with precision. Step 4. The insurance payout facilitates separate lives without a single day of missed work or financial. In this scenario, Ethan and Sophia remain friends. They are not traumatized by the court system, they are not bankrupt by legal fees, and their children do not witness a war. To proponents in academia, this is the pinnacle of social engineering. It is the victory of the rational mind over the irrational heart. But critics ask, what was lost in that efficiency? Was the marriage ever truly real if the ending was so easy? As we conclude this 10-part masterclass, we must look at the historical trends of the last century. We moved from marriage as a religious necessity to marriage as a romantic ideal, and finally in 2026 to marriage as a managed risk. This is the educational discourse on the ethics of divorce insurance in American academia. We have seen the rise of the algorithmic oracle, the global clash of actuarial colonialism, the ethics of the golden handcuffs, and the emergence of the insurance child. The math of the broken heart has been solved, but the solution has changed the very nature of what it means to be human. The ultimate takeaway for the American public is that we are no longer just citizens or spouses. We are policyholders in the most complex domestic experiment in history. The potential outcomes range from a new era of middle-class security to a total loss of the irrational passion that has defined human art and literature for millennia. We have traded the fear of the fall for the safety of the parachute, but in doing so, we may have forgotten how to fly. The data is clear, the models are built, and the premiums are being paid as we speak. But even as the 2026 experiment reaches its conclusion, a new and even more complex frontier is emerging on the horizon of American academia. While we have focused on the end of the marriage, a new sector of the insurance industry is beginning to look at the beginning of life. They are developing products for what they call genetic compatibility indemnity, insurance policies that protect parents against the financial and emotional risks of raising children in an age of CRISPR and advanced diagnostics. If we can ensure the end of a relationship, can we also ensure the outcome of our offspring? The ethical discourse is just beginning to pivot from the courtroom to the laboratory, and the implications for the American family are about to enter a dimension we never thought possible. The open loop of human risk is expanding, and the next chapter of this masterclass will take us into the very DNA of our future. Is there any part of the human experience that remains uninsurable? Or have we finally placed a premium on every beat of the heart? The answer lies in the emerging world of biorisk management, and the first case studies are already being written in the labs of the Ivy League.